Science and Technology posted a steady set of numbers in Q4. What caught our attention is the progress in capacity additions, helping the company consolidate its leadership in older products. It's also aiming at new set of products which have limited competition. In addition to that, the company's process innovation continues to help navigate volatile phases of basic chemical prices. In Q4, sales grew 14% QoQ, supported by new client additions and higher order flows from existing clients. While gross margin was stable on a sequential basis, operating margins were impacted by higher fuel and freight costs. In FY22, the company's capital expenditure was chiefly targeted at Unit 3, wherein plants for new products PBQ and TBHQ have been commissioned. Now, PBQ is used in agrochem industry and is majorly imported from China. Clean Science's current capacity is 40 tons a month, which it plans to double in H2 of FY23 to partially meet domestic demand of close to 1200 tons per annum. TBHQ production is meant for exports and like BHA, it is used as a food antioxidant. In addition to that, the company has doubled anisole capacity and increased BHA and guaiacol capacity by 50% each. Also, construction work for 2 new plants are on track in Unit 3 for Hindered Amine Light Stabilisers series 701 and 770. These products are used as stabilizers in master batches, pigments and aim to be commercialized by Q4 of FY23. To take advantage of the fiscal benefits, the company has incorporated a new subsidiary called Clean Finochem. Management mentioned that most of the new capex after Unit 3 would be undertaken through this subsidiary. A 34-acre land parcel has been acquired for the same. Here, Clean Science will initially focus on the expanded production of HALS series and few agro and pharma end market products. Over the years, the company has optimized the use of conventional raw materials, improved yields and reduced effluent discharges, which have consequently helped in cost competitiveness. For instance, the company manufactures sulfur-free BHA. It has also developed a catalyst to manufacture anisole from phenol and methanol, which eliminate the use of DMS and caustic soda that generate effluents. These practices have not only helped reduce wastage and effluent treatment costs, but also positioned it as the supplier of sustainable products. In a challenging business environment marked by elevated basic chemical prices, the company has been able to edge out competition due to differentiated process chemistry. For instance, for its star product MEHQ, wherein it competes with Solvay, the company has been able to gain market share. Competitors produce MEHQ by using hydroquinone, unlike Clean Science, which makes it through the use of anisole. In recent times, former method has turned unattractive because of sharp rise in quinone prices. Now, due to this, Clean Science could win a 3-year contract from BASF for MEHQ supply. An additional trigger for the company could be elevated energy prices. Now, due to geopolitical tensions and dependence on natural gas, European chemical companies could face major shutdowns, suboptimal operations, which can present an opportunity for market share gain in chemical products. In such a scenario, demand for upcoming HALS series could pick up. Having said that, margin trajectory could be a key watch. In recent times, moderation in EBITDA margins was due to higher operating costs, whether it's fuel costs, coal, freight rates, etc. The company is deliberately avoiding increase in price for some segments as well, wherein end market demand is fragile, for instance in cosmetics. Regarding new products, expecting a 40 to 50% EBITDA margin will be unrealistic, at least in the initial years. Yield improvement for the new processes will happen with time, and therefore some moderation in the supernormal operating margins are expected as the company diversifies into other products over the medium term. Now, we believe FY20 and FY22 are better reference points for the margins instead of FY21. Nevertheless, post a 45% correction from all-time high, valuations and EV to EBITDA of 31x for FY24 projected earnings are reasonable. While it still trades at a premium versus the sector, we believe it can sustain due to process efficiency and emphasis on green chemistry. In our opinion, the theme of sustainable growth will gradually pick up in the chemical space. And in addition to that, lean balance sheet and high operating cash flows support capex and R&D investments. With that in mind, investors can definitely consider accumulating the stock for the long haul.